If you are close to retirement or recently retired, you can't afford to miss this commercial. What if I told you one of the biggest dangers to running out of money in retirement was a risk you've never heard of before? If you've never heard of sequence of return risk, please check out the trailer at sequenceofreturnrisk.com. And remember, an investment in knowledge pays the best interest. Benjamin Franklin.
It won't happen all at once, but it will happen overnight. So my thing is like you can see it happen, and then all of a sudden it's Monday. There's a Monday coming. It might be this Monday. And when it happens, it's going to be for sure and for certain, and everybody's going to be in trouble. And you remember what happened last time. It's going to happen again, and it's going to be worse. Where are you going to be? And who's going to advocate the opinion to understand what should happen, what happened, and what we should do about it? And it's always Arizona. Tim.
Come on, Timmy.
Are you selling those shirts, Jim?
I actually will be selling the shirts on the website probably in a week or two. I've got a whole bunch of them that are coming out. All right, good morning, everybody. So, since this is being videotaped and since I do have licenses and this could be used against me in the future, I just have to give a quick, boring disclosure. This is for informational purposes only. Everyone's obviously going to have their own unique circumstances. Talk to your own financial advisor if you don't have one. I know a guy, lawyer, tax advisor, so on and so forth. Past performance is not an indicator of future performance. These are my opinions. They don't represent that of my company, my broker-dealer, or my RIA. Okay, there's the disclosures. So what I plan on doing today is I'll briefly touch on the strategies that I've come up with Ernie about these, rich Bitcoin millionaires. I want to talk about the different risks I see out there and why the pension funds, I'm pretty sure, they're going to go, just the timing of it. And I'm going to talk why I think that. Then also going to get into the different main retirement risks that are out there for people who are close to retirement or in retirement, and then kind of like the state of the union of what's going on in the economy and some things that you guys may or may not know. And if I end up talking a lot of times I talk really fast because I feel like there's a lot of stuff I want to get out, and I want to make sure I have whatever time frame I have, I just want to get out as much crap as I can get out, because Ernie's talking about them, pulling something out of their butt. Well, they've got a pretty big butt. There's a lot of things they can pull out of there. So, I'm going to try to get through as much of it as possible. First, I just want to give a real high-level overview of the strategies that we were talking about with Ernie. So, what a lot of people aren't aware of is when you hear guys like Bill Gates, give away their money, or Warren Buffett give away their money. They don't really give away their money. When you set up various types of charitable trust.
Is that loud enough for you guys back there?
Yes.
Let's be a little bit taller. All right, when you set up various types of charitable trust, we got to go to the camera. When you set up various types of charitable trust, if you set up one called a charitable remainder trust, and in the example I was using was, one of the Bitcoin gazillionaires. In this example, I was using a 55-year-old who put in this case, $15 million. Now, the government's going to make them at least take out 5% per year. So that guy, what would happen to him is he could put his Bitcoin, in this case, into a trust. And again, this is the oversimplification of what's really going on here. Put the Bitcoin into the trust. Then from there, it then allows him to legally diversify out. So you can legally then sell your Bitcoin and then put some into gold, put some into real estate, puts them into, foreign stocks, domestic stocks. They spread things out across the board, because right now if you sell your crypto, you're going to be exposed to capital gains tax. Even if you go from one crypto to another crypto, technically the government is saying that is not a like-kind exchange and that you're actually on the hook for taxes over there as well. So it's great that they have a lot of crypto money, but if you can't access it, and like the joke that Ernie was telling, then it's not really that pertinent. Like, great, you've got a whole bunch of crypto, but you can't use it. Fantastic. So what I'm talking about is a legal strategy where if they put their money into one of these charitable trusts, the money is then going to them for the rest of their life. So in this case, 5% of $15 million was $750,000 would be going to the Bitcoin gazillionaire. They then would also, on top of that, get a $4.789 million tax break, federal tax break deduction on top of that for giving away their money, but they were giving it away to themselves the entire time when they were alive. But it's way over everyone's head. So when all these guys get to grandstand about how philanthropic they are. What it is doing is privatizing philanthropy. It's a concept not a lot of people are really familiar with because it's, level 500 advanced estate planning type stuff. Now, in concert with that, what happens is upon their death, their money then goes to a foundation. It could be a foundation that they set up. It could be a foundation that they like, what have you. Then, there's a board of trustees, and then they manage the money in accordance to your wishes, so on and so forth. And then the other thing that's going on here is because the other factor is, well, hey, I can't give away all my money because, what are my kids going to live on? What am I want, there's heirs that I want to take care for. So what they do is they take some of that $750,000 that I was telling you about, and so it's like if you were a rancher and and with a lot of these ranchers, the big problem they have is that upon their passing, they have all this illiquid assets, and then they owe the government half. So you've got a guy who's got a $100 million ranch. Now he's got to find a way. Now his heirs have to find a way within a few months to come up with $50 million to pay the estate tax, which means a lot of those cattle are going to have to be sold off at fire sale. So what I'm trying to say is take some of the, in this case, maybe the milk from the cows, use it to buy a life insurance policy. There's ways to have the life insurance actually be not counted as part of your estate as well. So there's what they call ILITs, or irrevocable life insurance trusts. So again, this is at a high level. It's not, I don't expect anyone to understand, but I just want to get the point out there that this can be done. They, them, those are using this against us, and so we ultimately have to use the free market against them, because if we have the Ford Foundations and the Gates Foundations and all these other foundations working against us, the only way we can counteract that is by having our own foundations, for freedom, for liberty. So that's all I kind of want to touch on that. Do not try to do this on your own. Do not try to go to LegalZoom and set this up, because I will assure you that will probably end in disaster. But I do know the people who can make this stuff happen, and I'm one of the people that can help make this stuff happen. So what I want to segue into now is some of the things that I see out there on the horizon. The biggest thing I see on the horizon right now that's happening this month is what a lot of people are referring to as quantitative tightening. From 2009 until November or late October 2014, the Federal Reserve is printing massive amounts of money. On their balance sheet, it's about $4.5 trillion, $4.4 trillion. I mean, at a certain point, you start losing track of this stuff. Well, what they have been doing is every time a bond matures, they've been repurchasing the bond, and it hasn't been going out into the economy. Well, starting this month, they're going to start selling $4 billion in mortgages, and $6 billion in treasuries are going to start rolling off the Fed's balance sheet. So $10 billion a month. Now, if the purpose of printing all this money was to have asset prices going up, and Ben Bernanke was even admitting this, and I was telling my clients this in 2009, 2010, then if you're doing the opposite of that, then wouldn't that have the effect of having asset prices going down? So if printing money is there to make asset prices going up, then wouldn't doing the opposite of that probably make the asset prices go down? I mean, I don't really expect anyone at the Federal Reserve to be smart enough to figure that out, but that's just my layman's perspective of what's going on. Now, it's starting at $10 billion a month, and every quarter they're going to up it another $10 billion, all the way till they get up to $50 billion. And so that hasn't started yet, and I'm not sure what day it's starting, but it's starting this month. October is when they supposedly are going to start this. The other thing I see on the horizon is there's going to be a new Fed chairperson, more than likely in January, when Janet Yellen's term ends up. Now, my line in the sand for Donald Trump is, if he were to reappoint Janet Yellen or a guy like Gary Cohen, who's big carbon tax, Goldman Sachs, that would be the absolute end of the line for me. But one of the guys that the prediction markets right now are pegging at 50% odds of being the next Fed chairman is a guy named Kevin Warsh. Kevin Warsh was a former Fed governor, I believe, until 2011. I'm not an expert on him, but when I saw this in the prediction markets, I wanted to do a little research on him. Well,
I don't want a prediction market.
So prediction markets is basically people are betting on real money on who they think on different political events. And so I don't think you're allowed to do it in America, but people overseas, half the smart money is betting on this Kevin Warsh character. Well, Kevin Warsh is saying things like he was the dissenting vote a lot of times I mean, I'm not going to say he's like Ron Paul, because again, I'm not an expert on him, but just doing a little bit of research on him, he was a lot of times the dissenting vote where when every one of these guys wanted to print a whole bunch of money, and girls with Janet Yellen wanted to print a bunch of money, he was the guy saying, well, hey, maybe we shouldn't do this. Maybe this is going to lead to a lot of inflation down the road. Maybe this is going to lead to a lot of unintended consequences that no one in this room in the ivory tower is smart enough to figure out. He's also saying, I don't think the Federal Reserve should be slaves to the S&P 500. And so now if we can have this convergence of, quantitative tightening mixed with a potential Fed governor who wants to raise interest rates and who was the dissenting vote, back, when it wasn't really popular, when he's around all of his, Berkeley colleagues, because that's where, Janet Yellen hails from, is Berkeley, her and her husband. And so I think that's one thing that people aren't really, that's really not on anybody's radar right now, and that's something that is on my radar. But we've got a whole bunch of crazy things going on in the market where, from a valuation standpoint, one of the metrics is called the CAPE ratio. When I was here in March, I talked about it. What it is it's the price to earnings ratio or PE ratio, but it's adjusted over a 10-year time span. And the cliff notes of this is when it's high, it means the market's overvalued, and when it's low, it means it's undervalued. And so Dr. Robert Shiller, who is, a lot of you have heard of like the Case-Shiller Index. So this is his chart, Yale professor, not that means anything. But through his studies, what he found out was that every time it's in the top quintile of being expensive, aka where it is right now, so when you're in the top 20 percentile of being expensive, the market's forward 10-year return by market S&P 500 has only been 4%. Now, when it's in any other quintile, the market actually has a pretty good return. So if you're in the bottom quintile, aka like a 2009 type environment, the forward 10-year return is 16. If you're in the second quintile, it's 13. And this is like average over a 10-year time span. Third quintile, 11. Fourth quintile, 8. But right now we're in the fifth quintile, which is 4. So what that probably means is 20%. So if you're in the bottom 20%, so you're in the top 20% of expensiveness. I'm not sure if that's a word, but where we're at right now in terms of valuations using that ratio, we're in the top 20% right now, which would indicate a forward 10-year return of 4, which, if you even believe the inflation numbers. If you don't believe the inflation numbers, I wrote a 16-page little booklet on it called How It's Rigged. Maybe so that way if I ever run for office, I can be like, I wrote the book on how it's rigged. And I titled it. So, or you can go to the website, libertarianadvisor.com. If I only proofread it a couple times, so if you see mistakes, let me know. And so the other thing that is going on is that in all this, I'm going to build up to the pension system, because all this really has to do with where I see things going. But I also want to quickly touch on tax reform, is what they're calling it. But it's not really tax reform. I mean, I'm glad they're trying to get closer to zero, so that's a good thing. But we're just tinkering around with the edges until you come to grips with the fact that our money is made out of debt. In order to get the first dollar printed into the system on December 23rd, 1913, that had to be backed by debt. And so you can get away with that for a while, but once you're at $20 trillion of debt, then that doesn't even include Social Security, or Medicare, which is a greater unfunded liability than Social Security, and it doesn't include the wars or the unfunded healthcare expenditures. So the 20 trillion is like saying, going up to your financial advisor or somebody like me saying, yeah, I'm doing great financially. If you don't count my mortgage, student loans, car payment, child support, alimony, then yeah, if you don't count all the shit I actually spend my money on, then yeah, I'm doing pretty good. And so this 20 trillion doesn't even include any of that stuff. And so we're at the point now where even if the rates were 2% or 3% at the Fed funds rate, that means the government would have to borrow money probably at 5% of 20 trillion is $1 trillion in interest. And again, I mean, at what point, are we not complete economic slaves? And this is what really got me into this, is when I figured this out after reading Creature from Jekyll Island, and kind of to back things up. In 2007, I was in a class on the Federal Reserve, where my classmates, I wasn't on the competition because I was playing water polo instead, but the guys in my class who went to this competition, they beat out Harvard, Yale, and MIT, and all these big schools, won the National Fed Challenge. And so, I was in a position where, if I was on the class that won the national competition and I didn't know it was private, well, then how the hell does anybody else know it's private? And then if I had all these different licenses and I didn't know this, then how does anybody else know this? And then that's what really, sparked my passion of all this, is because, I was in the prime spot to know this stuff, and I didn't know this stuff because most people aren't taking classes on the Fed or public finance or any of this stuff when they're in school. And so that's what really, lit a fire up underneath me. So I'm glad that the rates are getting closer to zero, but, no amount of tax, tinkering around with the edges is going to save anything. There's no saving the system. It's at the point where it needs to be, completely overhauled, scrapped. You can't have the money backed by debt. Until that, if you can address the politicians could be 100% right. Yeah, fat chance of that happening on every single issue. Let's assume they were right. Let's say you put Ernie in there or Ron Paul, and they're right in every single issue, but you don't do anything with the Federal Reserve and the fact that our money's from debt. Doesn't matter. Doesn't matter whatsoever. So now I'm going to get into the pensions. So according to the government's own numbers, they are only underfunded by $1.4 trillion at the state and local government level, which it amounts to 75% funded. According to the American Actuarial Standards Board, they're closer to $5 trillion underfunded, or 39% funded. And the other problem is you have baby boomers right now. 50% of them have less than $100,000 saved for retirement. And so a lot of times people use something called the 4% rule, meaning you take 4% off your investments, and that's so if you have $1 million, you can live off $40,000 a year. Well, if you have $100,000, you can live off $4,000 a year. And so half of baby boomers aren't even going to be able to live off $4,000 a year, and they're going to have to completely rely on Social Security. Their Social Security average payment per year is a little over $16,320. So you're talking that the average baby boomer is going to have to subsist on $20,000 a year, and then the people at the Federal Reserve are going to be printing the money, which is then going to be devaluing everything they buy, and then the government's going to rig the inflation data. So even if the inflation was 3 admitted, and it might really be 6, and so they're only going to give you a cost of living adjustment of 3 when it was really 6, and then they're going to rob you on the other 3. Even at like a 3 or 4% inflation, the average retiree is probably going to see everything they buy, quadruple over their lifetime. So, that $20,000 meager amount you're going to live off of, when you're 66, if you end up living to 90, is going to be like $5,000 a year, assuming like a normal type of like 3 or 4%, not even assuming a much higher level. And the guys that have $100,000 in savings, they're not going to have a bunch of money in stocks that are going to help them counteract this. So we're in a real crisis. And one reason why the math and all this stuff is so much worse now than it was in 2007 is because the baby boom started in 1946. If you add 62 to 1946, you get 2007. So the baby boomers were just starting to hit Social Security age in 2007 when all this stuff started going down. Now, the baby boomers, 10,000 a day are turning 65. Another 10,000 a day are turning 71. At 71, or technically the April 1st after you turn 70 and a half is when the government makes you start taking money out of your 401ks and IRAs. And so now we're in this situation where there's going to be this forced withdrawal from the seniors' retirement accounts, and there's going to be forced withdrawal from the pension funds because in 2007, a lot of the baby boomers weren't actually withdrawing funds. So if you average, let's say 10% a year or 5% a year or 4% a year, and you're not withdrawing funds and everything goes down, it doesn't really matter if you're not withdrawing funds because you can ride things out, as long as you weren't in something terrible like Lehman or something that completely bombed or went to zero, you're probably going to, be okay. However, once you start withdrawing funds, the math changes completely. I recently just built a website. It's actually live now that you can go to. I haven't really pitched it out to anybody, but it's called sequenceofreturnrisk.com. And so I have like a 3-minute little presentation on there that then links to a 15-minute presentation if you guys are interested enough. Sequenceofreturnrisk.com. So my main business site is Focal Point Wealth, but I've got these 3 other websites I'm trying to tie into it, and that will probably be done in the next month, but hasn't been done yet. But with sequence of return risk, why this is important is, let's say you have a situation where the market goes down 20% and you're pulling 4%. So the typical person that is pulling 4%, market goes down 20, they would have to have their accounts go up 42% over the next 3 years to get back to even, to have their, basically have the principal go back to where it was before. Now, if we're at 39% funding ratios after a 9-year supposed recovery and bull market with, you know, tax receipts at all-time highs and stock market at all-time highs and basically everything at all-time highs, you know, maybe media corruption at all-time highs, everything's at all-time highs, and we're still in this disaster scenario, then what's going to happen the next time the market goes down? So it doesn't matter if the pension funds average 10% a year, if they in the next couple of years have a big negative, you know, 20, 30, 40, 50%. The California pension, they're called CalPERS. I don't have it's in here, it's my article somewhere where it's CalPERS, California Pension something retirement systems. Anyways, they just bumped down their assumptions from 7.6% down to 7%. They haven't even been earning anywhere even close to 7%. They have 60% of their stocks, or 60% of their assets are in growth stocks right now. I mean, growth stocks in 2008 went down close to 60% at one point. And if you go down, yeah, and I've got the math here. So if you go down 50%, and you're pulling 4, you've got to go up 132% over the next 3 years just to get back to even. And so this is assuming you're at even to begin with. These guys are only at 39% funded to begin with. And if you go by their own numbers, they're at 75% funded. Oh, great, we'll use your number, 75%, only $1 trillion underfunded. Like, okay, let's use that number. So that means they're going to have to pull a whole hell of a lot more than 4%, probably a whole hell of a lot more than even 6%. And then there's all these other factors that play into this. And really, these factors play into pension funds even more so than your standard retiree. Can anyone tell me out there what actually is the biggest risk a retiree faces?
Yeah.
Eating too much bacon at the
Yes,
morning
sir.
breakfast clubs.
Inflation.
That's one of them. So I've got 7 risks. But Ernie was pretty close here. Ernie said death.
Sexual transmitted.
It's actually living too long is actually the greatest retirement risk. They call it longevity risk because the longer you live, it's a risk multiplier. So the longer you live, the greater the chance that inflation can ravage your retirement. The greater the chance deflation could actually happen, and there is a scenario where deflation could happen. The greater chance that you could have sequence of return risk or market risk. But I'm going to real quickly kind of go over some of these big risks that are out there. So longevity risk is number 1, just because it's a risk multiplier. The other ones, you know, aren't in any particular order here. But you got market risk. So think, you know, 2008, 2007, when everything went down. So that's the risk that the market can go down. I think we're all familiar with that.
So when you say risk on the first one, it sounds like you're saying risk to the people that give us the money, the risk to the government. It's not a risk to me to live too long.
To back it up, I said for the retirees, like an average retiree. Not I wasn't talking about a pension fund in this case.
No, Social Security. It seems like I win if I can live longer. I get more money if I'm alive next year than this year. So it's a risk to the people paying me the money. That's banking.
I mean, Social Security, and that's, yeah, whether or not you're going to have guys like me who are going to say, you know, that's not my debt. Why should I be paying your Social Security? It's not my problem that generations above me let politicians squander all of it and people weren't paying attention. So now now my kids and grandkids have to be slaves to pay you back. So there actually is a risk for you, because if you get guys like me, I'm like, well, you know, if for me, I'm like, fine, figure out the time value of all the money, of all the pensions, and boom, we'll print it up, give it to you, and then, because if you can either deal with all the inflation immediately, or you can deal with all the inflation over time, either way, you're going to get to the same point, but it's not my debt, so I don't think I have any responsibility to pay Social Security, and I still do, so you're welcome for all the people out there collecting Social Security.
I'm still paying your
out there.
Security.
They borrowed ours.
I'm paying yours.
The longevity risk is not the fact that you're still getting Social Security money. It's just that when you're 80 years old and you get $20,000 and
Purchasing power.
yeah, you go 5 years later and you're getting $20,000 and it's buying you loaves of bread.
Yeah.
So there's a longevity risk. You know, I'm living longer on less.
Yeah. Yes, sir.
Yeah, I just want to add one more thing about inflation. The second thing is debt. Overall government debt, personal debt, worldwide debt, which is, of course, going to cause inflation.
Oh yeah, absolutely. And I mean, and a lot of the beginning of what I talked about was, 20 trillion in debt and how that doesn't include Social Security, Medicare. So I'm definitely hip to the fact that we've got too much debt. But when I say longevity risk, I was specifically talking about what's the average retiree. So I'm not talking about Social Security or pension. I'm talking about, anyone out here who's retired. The greatest risk is actually living too long, because then it amplifies all the other risks that are out there. It's a risk multiplier. So I mentioned we've got market risk. So think 2008, things going down. And for reference here, the stock market earnings are actually they just basically eclipsed where they were in November 2014. So the stock market is a whole hell of a lot higher, but the earnings are basically, now they finally got back to where they were in 2014. The next risk on here is inflation risk, which I think we're all, pretty aware of that. Now, there actually is a chance that there's going to be some deflation risk in the interim. Now, I don't mean deflation as in like the government pulling the money supply. I meant deflation in terms of kind of with a market risk of asset prices going down. And the reason I say this is you've got a lot of money that's stuck at these zombie banks. You have the average retiree or baby boomer who only has $100,000 in savings, and they've got a 3,000 square foot house. Well, guess what? This is going to create pressure for these people to start downsizing, to start realizing they didn't save enough money, start realizing, hey, we don't need a Lexus in this. We need to be able to eat. So a lot of the retirees are going to have to, A, start working longer, and B, they're going to have to start downsizing their lifetime, which that could then actually have a temporary deflationary effect while this is going on in the interim. But I'm not smart enough, and nobody's really smart enough to know the timing and all this stuff. And when I was at Nexus, I asked all basically the legends this, like the Peter Schiffs and G. Edwards and Doug Casey's and Ron Paul and anyone I could steal some few minutes with, how they think the next crisis is going to play out. And pretty much none of them could tell me, which is a good sign, because otherwise it'd probably be lying, because it's so unpredictable. Because when you've printed this much money, the last people that know what's going on is the Federal Reserve. And I think I started an article yesterday, even on one of my mainline financial advisor things, saying, when are people going to stop listening to Janet Yellen? And this was on a mainline. This was not on like Zero Hedge. It was on like a mainline advisor thing I get. So we got longevity risk, market risk, inflation risk, deflation risk, sequence of return risk, which I already highlighted. And again, I've got the website, sequenceofreturnrisk.com. And the reason why I'm getting so active right now is because I wanted people to say, where were you during this, and how come you didn't warn people? Well, I am. So consider this a warning. In 2007, I was running my school's student managed investment fund, specifically in financial stocks, and I said, don't buy any financial stocks as a 21-year-old, and got my butt chewed out by every single dean, everybody. And then that fund had one of the best performing endowment funds in all of America in 2008, and at one point was the top performing one. I didn't get any thank yous for doing that. Now, the other big risk that you have, and this really plays into the pension funds, and this really plays into retirees, is a concept called interest rate risk. Has anybody heard of interest rate risk out there before, knows what that means?
Yeah, they cut your interest rates down to 0.75 of 1%.
I guess that's one way to look at it, and that's true. But when you cut the rates down, what happens is the price of bonds works like a teeter-totter. So when you raise the interest rates up, the underlying values of the bonds go down. When you lower the interest rates, the underlying values of the bonds go up. So I mean, basically, since I was born in '86, that's when rates were kind of peaked out, and they've been going down ever since then. And so retirees who had bonds were actually making money, and they had interest rates that could buy them things. And even going back to 2007, when we put the fund into treasuries, you could actually make money in treasuries. I mean, today you make next to nothing, but you're taking on what's called interest rate risk. So here's how it works in real life. You're in a bond fund with $1 million. Let's say you've got a 10-year duration on the bond. Rates go up 1%. Your $1 million is now $900,000. Rates go up 2%. Your $1 million, because of compounding, is probably like 780-ish. So for compliance reasons, I don't know the exact number off the top of my head, but it's around there. So you guys can see, well, this could play a lot of danger. So if you have a Federal Reserve that has $4.5 trillion on their balance sheet, that's all bonds, and they are talking about rates going up. Like, do they not have calculators? Are they complete idiots that if they obtain their objective and actually raise interest rates, then they're going to blow themselves up and blow everybody else up? And about a year ago, when Brexit was going on, one of the congressmen out here, David Schweiker, was speaking with Janet Yellen, and he asked on Facebook, does anyone have any questions? And Schweiker actually picked my question, which was basically the scenario that I was just laying out right now about interest rate risk in the Fed's portfolio, and what's going to happen with that. And Janet Yellen's response was that that's impossible. So Janet Yellen told me that my scenario is impossible, and that question actually then got picked up on the Peter Schiff podcast, where Peter Schiff's like, yeah, it was a boring day except for the one question, and it was my question.
What was your question?
It had to do, it's kind of inside baseball, and so that's why I knew Schweiker would be one of the only people smart enough to understand this, but it had to do with interest rate risk. And the other concept is, right now, at the time the Fed was collecting 0.5%, or the Fed was giving to the banks 0.5% in interest. So we actually pay the banks not to lend their money out. Go figure.
Yes.
So we were paying the banks at the time 0.5% interest to not lend their money out, but we were collecting 2%. And so there's a spread there, so the Fed was actually making money on this. And so my question was, well, we've got all these longer-term bonds in your balance sheet, we're collecting 2%, and you guys, all of you charlatans think that, are claiming that the rate's going to be 3% within a couple years, which is probably not, but you guys are claiming it's 3%, you want to get it to 3%. Well, if you're paying the banks 3% and you're collecting 2%, and then now you're losing 1%, are you going to start sending? Because what happens now is the Fed actually sends the Treasury they actually give back what they call it. They give back 94% of the profit, which means they skim off 6% and give it to the banks. Is the other way to look at that. The glass half empty. Yes, sir.
If they keep raising the interest rate, the cost of carrying the interest on the national debt will become impossible.
According to Janet Yellen, sir, your concerns are impossissible. It's what she told me.
Well, if you just print more money, yeah.
Well, we got people from Berkeley running stuff who live in these ivory towers who don't know anything, whose greatest concern is that the things you guys buy, the prices of it isn't going up fast enough. The number one concern around the world of central banks is that everything you buy doesn't cost more money quick enough. The number one concern is that there's not enough inflation. Well, they're going to get, hold on long enough, and they're going to wish they never wanted all this inflation because it's all being pent up.
In my reference point, and I'm not as much educated on Jew, they're intentionally doing this to destroy the whole American economy, the world's economy, to come up with a new thing for control, to market the beast, the back of your right hand or your forehead, you can't buy or sell. So to me, it's all by design. Where you're thinking the Federal Reserve, they don't know. No, I'm thinking no, they do not.
Well, I'm very familiar with. You got Paul Warburg, who was the first Federal Reserve chair, basically the predecessor of the Council on Foreign Relations, where he said you shall have one world government. It's only a matter if it's through consent or request. So I mean, the ultimate plan is to. And believe me, there are a lot of people there who just don't know what's going on, so it's not all a big conspiracy. But the ultimate plan would be to have like an SDR, special drawing right, where you've got this one world currency that's made up of all the other currencies. So you can still use your dollar, but it's going to be tied to this other fiat BS. And maybe now they'll try to tie it into crypto, so then that way they'll have crypto ushering in the mark of the beast. But that's kind of more Ernie's forte of getting into all that stuff. But I mean, the Federal Reserve is. The fact that she said it's impossible, I mean, an alien attack tomorrow could be possible. I mean, anything could be possible. And she's saying that my scenario was impossible, which, we've got it on tape now, so at least, I'll maybe be able to make like a Peter Schiff was right type video, at some point in the near future.
Well, you got to tell Peter Schiff and Aspen, this story. He goes, that was my question.
And he tried to hire me, and I turned it down. So.
Did he really?
Yeah, he goes, well, do you want a job? Because I was in Scottsdale.
I'd do it part-time.
The question I had, how do you think the demise of the petrodollar is going to impact people here domestically? Because more and more countries are opting out of the petrodollar and they're paying for oil with gold.
Yeah, I mean, not only are countries opting out of the petrodollar, but Steven Mnuchin, the Treasury Secretary, another Goldman Sachs guy, he was threatening China about 2 weeks ago, saying, "If you guys don't play by the rules, we're not going to let you use the dollar." I'm like, How effing stupid are you? Not going to let them use the dollar? You're playing right into their hands. And then you think that, I mean, if they tried to get off the dollar, we would end up bombing them. And now we are threatening them saying, you know, you're going to get off the dollar. I mean, I can't even believe this. So
there you go. We quit. No, you're fired.
Yeah, that goes back to what I'm thinking. The Secretary of the Treasury, Minutia, whatever the name is, he's from Goldman Sachs. Trump put him in there.
Right. Right.
They're doing this on purpose. They're playing us. It's all got to do with the money, the love of money, and control.
It's power.
yeah, I mean, ultimately, the only reason this whole entire charade that we call basically life is able to go on in America is because, you know, the dollar is backed by, you know, force and fiat, where if other countries weren't buying their oil in dollars, this whole thing would have never gotten to the point where it's at to begin with. And we are expediting this off of this course.
Yes.
What do you see in the future for precious metals, gold and silver?
I mean, long term, I think it's a good hedge. Where, I mean, if you have 5 to 10% in your portfolio, I think it's a good idea. But I don't look at it as an investment from the standpoint of I'm in this to make a lot of money. I kind of peg it as, this is the real money, and the price of the dollar is just a reflection of, the perception of what's going on.
Would you agree that gold and silver is the only real money if it ever existed?
And palladium and platinum.
Yeah, I mean, it's something tangible, and I think just the other day I saw Ernie sent me an article yesterday where it was from Zero Hedge, and it was I think it was the guy from Goldman Sachs, Lloyd Blankfein, talking about Bitcoin, or maybe it was the CEO of Morgan Stanley saying, well, in the 70s we stopped backing the dollar with gold, and people accepted that, so maybe people will accept Bitcoin. So. Ultimately, money comes down to what people are willing to accept. The problem is it can't be tied to debt, because when it's tied to debt, we're in this high-tech slavery. And honestly, I'm in a position where I benefit from this because, I manage money for people, and when we print more money, the values of the stocks go up. When the stocks go up, my clients make more money, so then I make more money. And
Don is going to pass around the hat for a little.
When the stocks go up, that's because of inflation. It's a false dichotomy.
No, I agree, because if you look at the top
really dirty hat.
Look at the top performing stock markets in the world, it's places where the currencies collapse, so like Venezuela, and so that's why I think it's important to have stocks. I think the stock market is going to be at $1 million someday, but it's going to be at $1 million because it's going to cost you $300 a gallon in gas.
Yeah.
And so it's important for people who have money to be diversified, where they have assets in the U.S. stock market, foreign stock markets, precious metals, gold, a little bit of crypto, real estate, and because there's no silver bullet of I'm going to put all my money in one place, and well then again, I would have thought the stock market would have went down when we stopped printing money in October 2014, but so I think we're already living on borrowed time, and I don't know when it's going to happen.
In my mind, I'm thinking of it's not so much the value or the cost, it's purchasing power. That's why I lean towards metal, because I bought metal, but it's not up there, and I'm losing as an investment. But in the long haul, when the whole thing collapses, when you want to start bartering and trading, I think I'll be ahead of the game. So to me, it's purchasing power, and they play games with it, as your article says. They're lying about the inflation rate, blah, 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 how they're counting the debt, and all this debt they're owed the banks. It's my understanding they owe the banks. They don't owe me and you in that sense. They owe the banks. The banks have got to figure out how to take what you have. And then they call it a debt, and it's through that derivative housing market, which is a scam, and now student loans is coming on us. The whole economic system is a scam. That's why some of us work for the imperishable, not the perishable. John 6, 27, 28.
We definitely
get that in there.
You're definitely preaching to the choir, because I have the book How It's Rigged. So you don't have to tell me. You don't have to tell me how. You don't have to tell me that it's a big scam. But ultimately,
so this is before you finish. I want to make sure people. I want to make sure that we get a clear understanding of your opinion for compliance of your not, whatever. But the opinion of how financially the pension plans across this country, municipal, private, how that's going to unwind. Because before, when the thing happened in 0405, remember, it was the airline industry. The airline industry, all these pilots and everybody thought that they were putting all this pensions in, and it just got redone, restructured. It's not yours anymore, and it's gone. But it's got this federal backup plan, and we give you so many pennies on the dollar, and you're screwed. Yes. So this has already happened in this country. It already happened. Yeah. So in other countries like France and so on, I'm sorry, it's not your pension, it's our pension, and what. So now Cyprus. I need your opinion of how, and quiet, I need your opinion on how this is going to transpire, what is going to get hit first? Is it going to be private, company? Is there a pool of something? I had no idea this airline thing had their own backup crap. And now you got
Everyone pays into what's called the Pension Benefit Guarantee Corporation. But again, it's
They
sort
took
of,
it all,
it's like
just
an
got one in
it's like an FDIC. Yeah.
AIG.
But FDIC is like me trying to backstop Bill Gates. Like saying, oh yeah, I'll insure you, Bill Gates, but yeah, here's my bike, whatever you can sell it for. I don't know. And a few other trinkets.
But don't you think the pensions are backed by the stock market because all the pensions invest their money in the stock market keeps going up? That the pensions.
But then we've got the, and that's where it's a sequence of return risk, because it doesn't matter if the pensions average 10%, if there's this 5-year period where they go down for a while where we've got the demographic risk of the senior baby boomers who are just now starting to poll, because in 2007 when things went down, baby boomers weren't polling. Right. Now the baby boomers are polling, so they don't have another 9 years to go ride this out, because this is going to happen. And I don't know what's going to be the first domino to drop, but what's probably going to happen is the politicians aren't going to have the courage to let the politicians are probably going to end up, demanding that we print this money to go save everything. And so getting back to your point is what I'm trying to do for my clients is ultimately protect their purchasing power by being diversified in different places, because it doesn't matter if you have $1 million and 10 years from now you still have $1 million if everything you buy costs 3 times as much. So what I'm trying, and I think, like Peter Schiff made an example, and you've made this example where, an ounce of silver can always buy you a nice rifle. It doesn't matter if an ounce of gold can buy you a really nice rifle or a really nice suit. And it could do that, 5,000 years ago or 100 years ago, and it could do it now. So when the price of gold went down to 600, you could buy a nice rifle for 600. When price goes up to 1,200, you could buy a nice rifle for 1,200. I mean, so I'm really more concerned of protecting my client's purchasing power, not whatever the dollar amount is on their statement necessarily.
Yeah, well, you read The Creature from Jekyll Island. I mean, what we're talking about here is the Federal Reserve note, which is a counterfeit, phony paper money.
Yes.
Backed by absolutely nothing, but
Yeah.
all the trees in the forest and all the barrels of ink they can print.
Yeah.
We're not talking about the real dollar. What we have is not dollar bills, they're FRNs. It's a phony deal. It's unconstitutional.
Yeah.
You read that.
It's
And so-
unconstitutional.
yeah. Well, I mean,
Hopefully our government doesn't get any ideas. Hopefully our government
I
doesn't.
know it's a joke. I know the Constitution's a joke today, but that's what we got to get back to.
Wasn't
We gotta
George
get back to
Bush
the
that said
rule.
that's just a goddamn piece of paper or something like that?
Yeah, I know.
Worthless.
But there's actually other countries that are even doing things more messed up than we're doing, which is giving this false facade. So in Japan right now, what they're doing is, and again, that's old school. They're not taking all the trees and ink. They don't use ink anymore. They just print it up on
Well, sure.
digits.
It's
Yeah.
not
So-
to click them out.
It takes too much time to print the money out of nowhere. So what they're doing in Japan is they're taking money out of thin air that they're just
Yes.
typing up on keyboards and buying up their own stock market with it. So
Yeah.
their version of the S&P 500, the Nikkei 100, they're buying up their own stock market with it to the point where I don't know the exact number because it changes all the time. There's too many numbers to keep track of. But it's like 70, 80, 90% of the new issuances are being bought by Japan's central bank. And so it's rigging everything. We're living in this bullshit economy where everything is being artificially manipulated by the central banks. This year alone, there's been $2 trillion worldwide that's been injected into the markets by other central banks around the world. Something like 40% of the new bond issuance are actually negative around the world. In 2014, the Federal Reserve, there's something called dot plots. What dot plots are is it's where the Federal Reserve governors, it's their estimation of where they think rates will be in a 1, 2, 3, 4-year time period. You go back to 2011, 2008, they were saying by 3 years ago the rates would have been like 4%. And so you go back to 2014, they were still thinking it was going to be 3 or 4% by now. And I was calling BS on this all along, and that was like the tinfoil hat conspiracy theorist. I'm definitely 3 standard deviations away from the average financial advisor on a lot of these opinions, so I'll just get that out there, that these are not the average opinions, because a lot of them don't know enough to have an opinion, at least that means anything. But I forgot where I was going with it. What was I talking about? My blood pressure.
That blonde hair girl.
The plot thing. The plot.
Oh yeah, so with the dot plots, so in 2014 what was going on is that we stopped printing money. It was like right around this time, 2014, like Halloween. 2 days later, the Bank of Japan massively increased their program. About a month or two after that, the ECB out of nowhere massively, or for the first time ever, started up their bond buying program. So people were of the opinion, it was the wrong opinion, that okay, well the rates here are going to be 3 or 4% soon, and we better, things are going to be great. And I had clients saying, oh, well, I don't want to do this strategy because the rates are going to be high, and rates are going to be high. I'm like, well, no, they're not. They're just, it's a fake it till you make it. They can't be high because you have too much debt, and if they were high, it would, they would cook their own goose, and they're backed into a corner. They're backed into a corner that they backed themselves into, and there's no way out of it. Do you want? What are the options? Do you want to get punched in the face or kicked in the nuts? I mean, I don't know. Either way, it's a bad
face. Wait.
Yeah, okay, the face. Yeah, the face. So it's bad options all the way around. But what happened in 2014 is that people were like, okay, well, we're on this normalization period, and so the dollar shot up in value. It shot up like 40% or something like that in over a very short time span. But that's because other central banks are printing money, so it made the value of the dollar look relatively better. What also happened at that point is that China had their yuan tied to the dollar, and so when the value of our dollar went up 40%, it meant that the value of the Chinese yuan went up 40% as well because they pegged it, which meant if you were a German citizen buying Chinese crap, now all your Chinese crap cost 40% more, and so everybody then blamed that that little crash that happened in 2000 and to start year 2016 is when the market started on a violent downturn, and then people were probably thinking, oh well, the market went up. Like what changed? Did the company's profits go up? No, they actually got worse. Did the GDP expectations go up? No, they actually went down. So all the actual real hard data was going down, but then the stock market went up. So that's why I gave a presentation in March called the Trump effect and why good news is bad news, is because there was so much bad news coming out, which gave cover to the Fed not to raise rates. So the bad news meant that it was good news, and so when we have good news, and I say this in quotes, that's less of a cover for the Fed not to raise rates, which means they're going to have to raise rates, which then leads to bad news. So we live in this, twilight zone where good news is bad news and bad news is good news. Or really today, it doesn't matter. Good news or bad news, it's all good news because the stock market is going up no matter what. It's like, oh, North Korea is going to go bomb somebody. Oh, great. Another 100 points. This thing's going to happen. Oh, another 100 points. Oh, the dollar could collapse. All these things could happen. Oh, great. Doesn't matter. Stock market's going up. And so there's another index called the VIX index, volatility index, and it's been hovering at, basically lows since the last 30 years, since my lifetime. Very, 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 very quiet right now. But there's something else called the global chaos index, and that's through the roof. So how do you have a global chaos index that's through the roof, and then the volatility index is all the way down, and at some point something's got to break? And then how do you have people fleeing to bonds, which are a safety, while at the same point people are going into the stock market, and then the main buyers of the stock market are actually the companies themselves. So then the companies, what they're doing is they're borrowing money, then they're using that borrowed money to then buy up the stock market. So a lot of these companies are earning less money, but now there's less shares outstanding, so the earnings per shares in some cases have gone up. So it's all these little accounting gimmicks. But what I do for, I guess I'll wrap this up now. What you guys can do as action items here is I do have that 15-minute presentation that you can get at sequenceofreturnrisk.com. And what I do with people when I meet with them is the first thing I do is really try to establish what their goals are. Everyone's going to have different goals. What's the best case scenario? What's the worst case scenario? Whether it's how much money you want to leave your family, whether how much money you want to live off of, and it's really establishing what those goals are. The other thing I would mention is how much risk can you actually handle. So I use a software tool that I spend a lot of money a month to use. It's not one of these little questionnaires that you see most financial advisors give out. I think it's the best one I've ever seen, which is why I spend a lot of money per month on it. And what it does is it tells you how much risk on a scale of 0 to 100 that you can handle. So let's say you can only handle a 50 risk. What I can do is then I can plug your portfolio in and tell you, okay, Mr. and Mrs. Smith, your portfolio has a 75 risk in it, and you can only handle a 50. And where I go from there is when I come up with a financial plan, I take the risk that I ultimately try to reverse engineer their retirement, whereas a lot of people come up with different financial products and they figure out how much risk you can handle, and then they put you in a portfolio that has the most amount of risk. Whereas I'm like, well, what are your goals? And then let's try to take on the least amount of risk to hit your goals. But first you need to know how much risk you can handle and how much risk is even in your portfolio. Because I've had little old ladies come to me who took the test and could only handle a 25 risk, and their portfolios were 88. and they thought they were in something that was like a 30 because, you know, a lot of these big, safe blue chip companies, a big, safe blue chip company like the S&P 500, the Dow Jones, carries a 78 risk, which a lot of people aren't aware of that. So when I come up with these financial plans, we're ultimately trying to reverse engineer to have them hit their goals, taking on the least amount of risk possible. Then I will simulate a sequence of return risk into the financial plan. So we do 1,000 scenarios, and then when somebody retires, what I'll do is, let's say they're 62 years old, they want to retire at 66. I'll say, okay, what if we layer in a negative, and then we're backing up a little bit, when we do the riskalyze or the risk questionnaire, I can simulate what will happen in a 2008 type environment, a financial crisis type environment. I can simulate what would happen in a good environment, interest rates going up environment. So all these different environments I can simulate using standard deviations. And so let's say your 2008 environment shows you going down 39%. Well, then what I'll do is I'll then simulate that and show, okay, your portfolio goes down 40% year one. What's that going to look like for your retirement? Because if it goes down 40% year one, it doesn't matter what we average because you got walloped year one. And so I will simulate that into there and really try to make as foolproof portfolio as possible. Again, you know, this is all subject to change because there's so much craziness going out there in terms of, you know, what could happen to the dollar, what could happen to, you know, any of the 9 million things we've already mentioned today. Now, the other thing I do is this is really only pertinent for people that are close to retirement or in retirement, is I am a big fan of different types of annuities. There's a lot of bad press out there. There's a lot of unscrupulous people out there selling them. There's a lot of annuities that are terrible for certain people. I've had one client who, you know, was a doctor making tons of money, maxed out at 401k, had tons of savings, and I got her into this one. And then I had a little old lady come to me who was in the exact same one, and I wanted to like punch that guy in the face, whoever sold it to her, because it was absolutely inappropriate for her. But I have an animation that I've already got the first run made. It's not. I haven't released it yet, so I wish I kind of did this next month. So. You know, if you guys, you know, want to, I can give you guys a business card and I can send you the animation when it's done. But I can mathematically prove how, you know, let's say somebody was 60% stock, 40% bonds. I can mathematically prove where if that same person that was, in this case, if they were 62 years old, if they had taken my strategy, if their 40% of their portfolio, in order to equal the amount of income that I could get them, they'd have to average about 40% per year for 3 years straight to equal the amount of income that I can get them from one of these strategies. But then that's only one tiny piece of the puzzle, because the other piece of the puzzle is, because I believe is, you know, let's say you need $50,000 a year to live off of, and you get $30,000 a year guaranteed. Well, what's the best way to get the other 20 guaranteed? And then that way we use the rest of your portfolio to hedge against the inflation risk. Because again, because a lot of these scenarios, you're going to win no matter what. You're going to win if there's deflation risk and everything goes down. There are certain ones out there where it's guaranteed to at least get your money back. And they also have income guarantees on it, where the income guarantees go up 10% a year while you wait. So if the market crashes, you can either get your money out and then have the same amount that you had to begin with, worst case scenario, or take the massive amount of income that you can get off of these. If the interest rates go through the moon, some of these are then invested in the market where, you know, there's certain spreads on them where, you know, if the market goes up, where it's not really a fee, it's more of a spread where they might take the first 3% because they're giving you a massive, they're giving you like a massive income guarantees off of these. And I get them in for income, not for an investment. So I want to be clear on that. Income, not investment. But let's say the market goes up 1,000%, you know, I think a lot of people would be happy going up 997 in that type of scenario. So, you know, so I think it's a good way for people to hedge. But again, if you're 30 years old, this is not really that pertinent to you. There's some that are, and again, this is not any blanket advice, because if you're, you know, it's going to depend on how old you are, how old your wife is, what health conditions you guys are in, you know, what your legacy concerns are, and so, you know, I had a family, you know, 2 brothers and a sister come to me, and all 3 of them, I'd recommend a different strategy for all 3 of them, because all 3 of them had something different going on. But there's a lot of bad salesmen that are out there who give it a bad name, and the biggest opponent of this is a guy whose initial is Ken Fisher. So Ken Fisher, if anyone has seen his commercials, he came out with a fund, I think in 2001, and recently he had to close down his fund. And the reason he closed his fund down is because of sequence of return risk. So his own fund went down like close to 60% in 2007. So it doesn't matter if you go down it doesn't matter what you average. If year 1 or year 2 or year 3, you get pummeled. And that's what I really want to stress today. And again, there's many different ways to get to the same place. I'm willing to do whatever my clients are comfortable doing. And, I think that if you prepare now, you can, maybe even be better off when all this stuff happens. And I'm kind of wish it happened a couple years ago. My wife and I've convinced her to sell our house. I moved here from New York, bought my house the month of the market low, and I've made 1,000% return on the house. And now I'm thinking about, I've convinced her that hopefully by January we can sell it and have rent. And it gets to the point where my money, I'd rather put it back into my business or do something else to make more money, because I think a lot of the money to be made from the housing's already been made in my standpoint. I'm like, okay, I'll take the 1,000% return and go try to use it as dry powder when this stuff goes down. Because it doesn't matter if it goes down and you've got no money to invest. Because I graduated in 2008 and then started my own company, making nothing at all. So I was really pissed because I'm like, oh man, this is like the best time ever to invest. And I was screaming at people, and now, so I'm not this permanent bear. In 2007, I put the money in treasury bonds. After everything collapsed, I started the day Lehman Brothers went down. So I started September 15, 2008. After everything went down, I was begging everybody not to sell. And then so now here I am begging everybody to at least know how much risk they have. On my website at focalpointwealth.com, I'll let you guys take the test for free. It takes 5 minutes. You can see how much risk you can handle. And then if you want, I can send you what they call a secure email, which will encrypt any information back to me, where I can put your portfolio in it and say, hey, you have got a 45 risk. In a 2008 environment, this is what you can expect. In a 2013 environment, this is what you can expect. And so you at least should know what you have and how much risk you can have. And you should also know, because if you don't plan, if you don't plan, you can plan on failing. But there's so many things that go into financial planning that you wouldn't think of. Just like riding a bike. This is what I'm going to close on. If you have to go ride, anybody but Keith, what does it take to ride a bike? Does anybody? All right. So to ride a bike is, the average person is going to take balance. You're gonna push your pedal down. But then if you get really into it, like I'm into it, because everything I do, I'm fully into everything. I can't run a 5K. I've got to do an Ironman. I can't just become a financial planner. I've got to get the CFP. Everything I've got to do. I've got to do it to the extreme. So on the bike, I've got a tool at home where it hooks up to my computer where it can actually measure the exact pedal stroke to see how efficient I am. I can ride any course I want in the world. I've got another tool on there where it's called a power meter, so I know the exact wattage I'm putting out at all moments. So I know exactly how much power I can put out for 1 minute, 5 minutes, 10 minutes, 2 hours, 6 hours, 5 hours, what have you. And so it's almost like cheating, where I have these different data metrics and things that I pay attention to. And then there's all like VO2 max and your heart rate. And then eventually the goal is to get your heart rate lower while you're putting out more power. And there's all these different things that you can do, whereas if you weren't in the cycling world, you would never even think of that stuff. So, there's a lot, and again, I'm not the smartest person out there. I'm probably a little bit above average IQ, but I've got a really strong work ethic. Again, I'm not the fittest person out there, but I've got a really strong work ethic, and there's people who are a lot more physically talented than me are out there, but I'm beating some of them because I'm smarter than them, and I know the power numbers, and I know what I can put out. And so it's not because I'm the best or the greatest or the smartest, it's because I work hard, and I want to work hard to make sure.
Unless you have a flat tire.
Yeah, which I've got to go change that thing right before I came over here. All right, so that's it. So I'm glad you guys listened to me, early in the morning about finance. It's not the easiest thing to sit through.
What should we look for? What's the signs of here it comes?
The signs are the quantitative tightening that's starting this month, and then the new Fed chair. If it's Kevin Warsh, he's a high interest rate guy, and so I think the signs are. I thought the initial sign was going to be when the Fed stopped printing money. Now it's when they're starting to, not roll over their balance sheet anymore, and they said they're going to keep rolling funds off. And the first thing they would do in another crisis, that they don't think is coming, but if there was another crisis, Janet Yellen said the first thing they would do is actually they would keep selling the bonds, but they would actually lower rates again. And so we're in this complete mess, and I think it comes down to the dollar, people accepting the dollar, and this quantitative tightening, and then the new Fed chair.
Okay.
What about?
I got one more question. I want to make sure we get in on this. I didn't think that this was possible. They did it, and some funky called it another thing, and then all of a sudden our debt shows up on the Fed balance sheet. Is the Federal Reserve creating money to buy U.S. debt that then they get interest on, that then we got to pay for, that then they, you see my point? They're just creating, here we print up a bunch of money that you owe, and oh, by the way, profit goes to the Federal Reserve for us, like doing the paperwork or something.
Yes.
Yeah, so I'll link some videos and I'll send it to you. You can put it on the Breakfast Club. So I made a quick 8-minute video called "Why We're All Slaves of the Central Bank," where I show how it works or doesn't work. So you've got the Federal Reserve, you got the Treasury. They ceded their authority to print money to the Federal Reserve. Then the Federal Reserve then sells bonds to Goldman Sachs and the other prime brokers at 0.25%, or that's what was going on in 2008. And then they buy it back for 2.5% or 3%. So it's this complete scam where we're getting middled twice to get our own money back. And that was kind of the crux of my question to Janet Yellen. So it's a gigantic scam, but you can go on their website and they're like, oh, this is a good thing because it's a free market, and it would be bad if we just put it on our own balance sheet to begin with, so it's good that we put it out to this competitive bidding process. Then the big banks know it's coming, they front run it, they make money off it. It's a huge, if you can give anyone here that deal, here, I'll let you borrow at 2, and then I'll appoint 2, and then I'll immediately buy it back from you at 2. Who wouldn't take that deal? So we're getting screwed.
Alex has got a question.
Well, Peter Schiff always kind of makes it example what he thinks is going to happen is they'll either try to raise interest rates or start selling bonds, and that's going to create the asset crash, and then they're going to automatically reverse it and go 100%, 180% the other way, and then you'll see the inflation take off. So is that what we think is going to happen? We're going to see a crash, and that's when people are going to realize, oh shit, they can't keep doing this. They can't ever tighten. They always have to expand the money supply.
Yeah, we've got to the point where the noose is around our neck so much right now that there's no way out of this. We can't lower rates anymore. But
people always have this in their mind, oh, well, one day they'll be able to reverse it. They'll be able to bring rates back to normal.
It's too far.
So it seems like they can keep making the game go one way as long as people think that one day they're going to be able to tighten. So as long as they make people keep thinking they can tighten one day, they can just keep playing the game. It seems like
ultimately, we're not really right until 51% of the money realizes what everyone here has already realized. So, it doesn't matter if you realize that the housing crash was going to happen in 2002 if everyone else didn't realize it until 2007. And so, Mitt Romney's dad once said, in politics, it never really pays to be way out in front on an issue. And so, guys like Ron Paul, who had the integrity to be way out on these issues, where, he laid out exactly what was going to happen in the crash, but those guys get no credit because he's a stopped clock, or it's only. But going back to your point, is Janet Yellen did come out the other day and said that they would continue selling bonds if things got bad, and what they would do is then reverse course and start lowering rates again. Lower to what?
That doesn't mean when they say the Federal Reserve goes, we, whoever the hell they are, they have any kind of, they make decisions independent of, they just sell bonds. We just want to put money without a congressional mandate, without a treasury thing. It's just the Fed from out of the blue, and guess what? We're making more money, and we're selling bonds.
Well, Ellen,
so they sell the bonds to the central bank, and they got this window. The only people that can participate is Goldman Sachs and friends, and they say, here's the debt that we're selling. You buy it at 0.2% or something, then we're going to buy that asset from you, put it on the Fed's balance sheet here, give them a profit for doing it.
Yeah.
Right?
Yeah, and then
that debt we owe to pay the debt back, while Goldman Sachs got a profit on it, and the Federal Reserve is sitting there collecting some money from us when we buy. Seriously, is that what's going on?
Yes.
Yes. It might be worse than that, but yeah.
This is not sustainable, is it?
It's not. That's why I'm out here screaming. It didn't do me a lot of good. My grandpa, after I read the book Creature from Jekyll Island's like, you need to shut up and all this stuff. And he's a really successful guy, and he was the treasurer of Carrier Air Conditioning, and a brilliant guy. And he's like, if you ever talk about this, you're never get any clients. You need to just forget all the stuff you learned because
you can't tell the truth, huh?
Yeah, and so you can't tell. But I'm out here, risking my CFP certification, risking my licenses because if they do try to come after me, I think it should be on you guys, for all of you, charlatans over there who have not warned against this. I think I'm doing my duty trying to warn against this. I've been given, because it's a lot easier to try to, fix something before a huge crisis happens than to wait for a crisis. I got an award from Sheriff Joe for risking my life to bring an illegal alien back from the dead who drowned at Lake Pleasant. and yeah, there's a whole story on that. But if I was actually lifeguarding and was paying attention to the guy and told him not to do it in the first place, and then was out there immediately to get them, it wouldn't be a big deal. But because I had just finished swimming and I wasn't with this guy and he was 100 yards off the distance, it took a miracle basically to bring him back from the dead after 15 minutes. And so right now, there is no more. I mean, the Hail Mary was Ron Paul in 2008, potentially 2012. There's no more Hail Marys. There's no more. Magic easy button. There's nothing that can fix this. But the people who have assets, which are probably only 5% of Americans, or maybe 10%, who have enough money in stocks to even, maybe be able to ride this out. But then are they going to have the wherewithal to stay the course? Because then what's going to happen is they're probably going to get freaked out if things start to go down initially. They're going to get freaked out, put all their money in cash or bonds, which will probably be a good idea to do at some point. But then eventually the inflation is going to take off and their money is not going to be worth the paper it's printed on. But I just don't know the timing of all this stuff.
Yeah, because our money is not really money. It's just promissory notes created by a fake private central banking system. The debt is not our debt, it's their debt.
Amen.
Correct.
It's their debt. Let them handle this thing. I mean, why should everybody suffer because of these crooks, socialists, communists, and criminals we got running this government? That's all they
I'm
are.
just a messenger.
Amen.
I'm trying to.
No, I got two things. One for Ernie, but let me get the second one first. My personal economic theory is if you have it, somebody wants to take it from you, but that kind of addresses, but forget all the college courses, but the other one, Ernie.
That was the IRS joke. The IRS, theirs.
Theirs, yeah. No, well, it's right. But anyway, Ernie, we're looking for indicators. It's my understanding they're wanting to borrow federal pensions. Wink, wink, wink. Like they did Social Security. To me, that would be an indicator your money's kaput.
That already happened.
Yeah, no,
Hold on.
that's-
I wrote an article on LibertarianAdvisor.com recently on that because whenever the debt ceiling, a lot of people were again, I was a big Trump supporter and probably did more to help Trump out than any other advisor in America. I started a Facebook page in end of August last year, and by the week of the election, it was reaching over 1 million people with the most anti-Hillary stuff that was out there. So believe me, I'm, not some communist but when you've got, but President Trump, a lot of people were grandstanding of, look at the great job he was doing. The debt hasn't gone up. Well, the reason the debt didn't go up is because they do these what they call extraordinary measures, and so one of the main extraordinary measure they do is the pensions funds, the government pension funds. There's something called the G fund for people who are it's sort of like the money market for the government. What they did is they borrowed over $200 billion from the G fund, and what that did was it was like if you have a credit card of $20,000 max and you're at $19,999, and then you figured out some sort of way to borrow money from somebody else and then pay that down for $2,000. I mean, what they did was this whole accounting gimmick where they stole, I think it was $237 billion from the pensions to then give it more headroom. There's a few other tricks they used. I have a whole article on it. I can try to link it in this thing. But yeah, they've already been doing that. They've been doing it for a while. Now they paid it back, but that's why the debt went up like $300 billion in one day, like a month ago. So if you're wondering why the debt goes up $400 billion in one shot, it's because they wait till the last possible second, and now they're talking about getting rid of the debt ceiling.
Oh yeah.
I mean, it's all a big charade. It's a big charade, anyways. But I mean, imagine the damage that's been done to the dollar already with having a debt ceiling. Like, what's it going to do when you don't have a debt ceiling? I mean, they already don't care about it, anyways.
That's going to make the Titanic look like a speedboat.
Yeah.
I don't know, and a lot of people have made this point, and so I didn't make this up, but, it's like what we're doing is arguing about the bar tab in the Titanic, or rearranging deck chairs in the Titanic. And I'm over here like, there's an effing iceberg over there! Yeah. Can we please do something about that? But yeah, in this day and age, if you want to balance the budget or talk about not making your grandchildren slaves, then we're the extremist. So, and I just want to also let you guys know that not all millennials are dipshits. I think most of them are, but at least, I'm on the extreme outlier of a lot of people my age.
This thing can't continue. It's got to crash because it's based on a foundation of total BS, lies, smoke and mirrors, and socialism, who doesn't understand a thing about real market capitalism and markets.
Well, I've been trying to think of a book title, and maybe it's got to crash.
But I think they understand it. They're working it. They're playing it. They're working it against us. Take your money. They know what's going on. They do know.
Never let a good crisis go to waste.
Yeah, no, stay up here. This is one thing I want to get a response on.
we're up against a philosophy of because they can, they should. You're too stupid, and they oughta. You know, I'm. What, in your opinion, if we were to oppose what's going on now, what are we in opposition to? What are we advocating for? What's the solution? What? No, we shouldn't do this. We should do that. What's that? And what's this?
I mean, I think decentralizing currencies where, you know, people could use whatever currency they want. If Ernie wants to make an Ernie coin, and then we can pay our taxes in, and the government can do like a bit, what is it, bit instant, or what's the, or no, we're not bit, where the bit pay, where it converts it back into fiat. So I think we need, yeah. So I think the ultimate solution is we should have free market on the money, where it shouldn't just be forced to use their counterfeit money. If we really are this free nation, then we should be able to free to use whatever money we want. And maybe we have to pay our taxes in dollars, but why can't the Fed just accept, you know, any sort of fiat and then use some sort of technology, then instantly change it over to fiat dollars anyway? So I think it's decentralizing the money and ultimately making sure the money's not backed by debt, that the money's not backed by your grandchildren being slaves and, you know, their future tax revenue ability. Because eventually you could take, here's a little news flash, you could take all the rich people's money, you could take everybody's money, but you've got this much debt, this much money, you can use all the money to pay the debt, and the debt would still be there, and all the money would be gone, and everything would collapse, and the whole system's bullshit.
But the thing you're talking about is money is not real money. It's phony BS. That's what the problem is.
Right, sure.
I think he said that several times.
I know, but we keep talking about money as though it's real, but it's not. It's promissory
It's what we're
notes.
using as money, though. It's an exchange. It's a meme.
Yeah, but sooner or later it's going to crash.
Just like Bitcoin.
Sooner or later, I'm going to be dead.
Oh,
In a
wow.
long enough time horizon, yeah.
It's whatever.
In the long term,
willing
in the
to
long
trade
term,
for
we're all
something
dead.
else.
So,
Let's do it with models.
with this knowledge, what shall we do with it? You know, that's one thing.
Hookers and
Lance,
coke.
go.
My humble opinion, I usually keep my mouth shut, but this is the most important speaker that ever speaks here, okay?
Yeah.
You can talk about all the money and whether it's worth anything or not, but you gotta take care of yourself. Talk to him. He's a financial planner. You get your house in order, you can buy the jetpack. You know, you're not gonna be able to do all this independent stuff unless you play a little bit with the system. So, talk to this guy.
Understand
Let him make you rich.
the system. Whether I'm playing with it or not that's kind of a matter of opinion how you're doing. Lance is doing okay because he, you know, understood. Well, at least his wife did. So this is the foundation and the understanding that we have, and then what? What shall we do? It's just have the knowledge and opinion, and this election cycle is going to be one of the first ones to where these young guys that had this awareness, that read, you know, The Creature from Jekyll Island, that has the ability to put information into a website, that's been able to use social media to be able to get this information out, which they're trying to stop. I mean, they're definitely trying to stop.
My censoring for a minute.
Yeah, go censor it, man.
Yeah, so last August, the Facebook page I created, August 27th, by the term of the election, I got over 30,000 people following it, and then I also was the first person to have a news list called Fake News go viral. Not saying that that's why it took off, but I was part of the overall zeitgeist of seeing where things were going. But you can see right after the election, and after I was getting throttled with all the anti-Hillary stuff, that the reach and everything just absolutely just. I mean, we're talking from 1,000 a day down to 2 people. So how do you go from 1,000 people a day liking you and subscribing to you down to 2, and telling me there's no Facebook manipulation, or there's no. I mean, even with that, I can still get the message out and still, if I wanted to, reach hundreds of thousands a week if I want to. But, you know, this is why we need things like the next Facebook that's up. We need the next decentralized thing because, you know, like what you say, it's Zuckerberg's friends. I'm under no illusion that it's a private company so they can do what they want. But, you know, a lot of times like Google, we're using in-hotel CIA money to fund it in the first place. So don't come here as this Creative Commons that we're, you know, going to be, you know, don't be evil, and then use my tax money to do it to then, you know, penalize me. So I mean, with communications, it's a big issue.
So this is what the campaign, what we've always benefited from for 30 years. There's like 3 months that a lot of people are paying attention to something. They go, all right, I'm going to do my due diligence and I'm going to cast a vote. I'm going to vote. I'm going to go, I'm still voting. And they go in, they go, boom, I want to check out this candidate, this candidate, this candidate. What? You know, just to implant a little something. You got signs up somewhere. You're directing them. You're making them like QR coded, made you look, go to the site of what? To learn what? You know, I mean, there's so many things. We can talk about Fiji. We can talk about Second Amendment. We can talk about, you know, whatever. But I'm telling you, it's the economy, stupid. Okay? It is going to, it's always been that. When this hits, it is going to be, everybody's going to get a reset of, damn, it affected me and everybody I know and love. If we can have hope and a solution and a decentralization of take care of yourself, freedom, there's an app for it, blah, 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 you do that. And you'll provide a platform for another expansion of awareness. And we had a big one. We've had a lot of them over the years in my lifetime, and I'm looking forward to the next one because I think we are close to the enlightenment or awareness of anarchy is only 100 kilometers that way.
2 miles ahead.
One of the most important steps anyone can take in investing is figuring out how much risk they can handle. We use a tool called Riskalyze, which gives you a custom risk number between 0 and 100, with 100 being the riskiest asset you could have in your portfolio and 1 being the least. In 5 minutes, we can tell you what your risk number is, and if you'd like, we can arrange to also tell you how much risk is in your portfolio, as well as what the hidden internal fees are, dividends are. This is incredibly valuable information you'll want to help prepare for your retirement. We know that not everyone who does this will become clients, but if you found this useful, please share this on your social media feeds. If you want to find out how much risk is in your portfolio, please email info@focalpointwealth.com or please call 480-771-PLAN or 7526. Thank you. Are you interested in learning more about your Social Security options? If so, we may have the perfect tool for you. You can get started by clicking on the banner ad above or the link below. From there, you simply enter your basic information and spouse information if that applies. Next, enter your full retirement age benefit amount. Then, on the next screen, you can toggle your Social Security start date along with your spouse's to see how that affects your cumulative lifetime benefits. Finally, at the end, you will be able to see how much money you are potentially leaving on the table with your current selection. And if you'd like to schedule a free consultation where we can take a deeper dive into your Social Security options using the more advanced version of this tool, please leave your contact info on the final screen along with the best time to contact you. If you get to the end and don't want to be contacted, that's fine too, but we hope that if you found value in this tool, that you can share the page with a friend on your social media feeds to help spread the word. We appreciate you visiting our site, and we hope to earn your business someday. And remember, at Focal Point Wealth Management, your future is our focus. Over the last 9 years of my career as a financial planner, one common theme emerges amongst retirees. Tim, I wish I knew this information when I was starting out, because if I did, I would be in a much different place today. If you are a millennial or are close to one that you care about, please share millennialinvestorblog.com with them, whether it's learning the differences between an IRA and Roth IRA or the importance of saving early. We've got them covered. We also have a place for them to open up their own retirement accounts for as little as $5,000. If they want our help, we'd be more than happy to assist them, but if they want to do it on their own, then that's fine too. millennialinvestorblog.com, where millennials' future is our focus.